And here we are again with more U.S. jobs data. Will it actually get these markets happy, or will it scare them senseless one more time? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live, and it is that magic time of the month, the first Friday. September 1st is tomorrow, and of course, that means that we have the monthly jobs report at a time when the market could not possibly care about anything anymore, because we have a Federal Reserve here that seems acutely focused on the labor market, and a financial markets public that is acutely focused on the Federal Reserve. And so what we've seen in the price action this week has been nothing short of a pointed response specifically to jobs-specific numbers out of the U.S. and relatively little else. What we're going to do here is we're going to see what is likely to come out of this report and really break down why it might move markets or not, and which way. Because this is very much a moving target. At this point, the market's clearly in some kind of a transition with how they interpret data and how they apply that to the Fed's reaction function. So we are going to break down what's expected, break down what the Fed is going to be looking at in these numbers, and therefore what the markets will care about seeing in them, and then how that's likely to impact stocks, currencies, commodities, rates, markets in general. Let's begin with expectations, and that should give us a steer on where to take this from there. Notice we've had a fairly steady deceleration in the monthly increase in U.S. jobs. So we peaked somewhere around February, March of last year, right before the Fed rate hike cycle really got underway. We can see that peak there at 904. That's 904,000 jobs added. That, I believe, is the February number. And from there, we've had a steady climb down. Nothing dramatic, nothing crazy, no straight line collapses, but a slow but steady deceleration in job creation. And this report seems likely to give us more of the same. The expectation is that we're going to inch a little bit lower to give us a net increase of 170,000 jobs in August. The key thing here is that against this backdrop of a slowdown in housing, the orange line there, which is the unemployment rate, is not only not rising, but has actually spent a good time of the declining. It has since anchored basically between 3.4 and 3.7%. To give you a bit of context there, 3.4 is the lowest level in close to 5 decades. So we are pinned to historically significant lows here on the unemployment rate, even as hiring slows. Now, we're going to unpick how this works and how this is even possible. But first, let's consider how these outcomes might hold up and whether these expectations should be looked at as something with relative prescient capacity. This is the Citi U.S. Economic Surprise Index. This is a measure we look at quite a lot. If you're a watcher of Macro Money, you've seen us use it repeatedly and for a multitude of economies. What you're seeing here is how data performs relative to baseline forecasts. And when the data performs better, the index goes up. When the data tends to perform better, the index is above zero. When it tends to perform worse, of course, it is below zero. And the further below zero it goes, the more momentum there is behind downside surprises. As we said, the more it trends up above zero, the more momentum there is in the opposite direction. All of which is to say, we are still tending to surprise higher on U.S. economic data relative to baseline forecasts. The index is well above zero. But momentum seems to be draining out of it. U.S. economic data is losing its capacity to close better than forecasts by a growing margin. Now, some of this is not just because the data is getting soggier, though it is. Some of this is actually good news because we've seen an upshift in expectations. So in so much as this is performance relative to forecasts, if the forecasts get better, but the performance stays about the same, well, then performance relative to forecasts, that margin by which you're able to beat the forecasts, that's going to close and become narrower. So some of this isn't so bad. This isn't all U.S. economic data weakening, but it is certainly setting the stage for a number on this NFP report that could be a little bit soggier, that has less potential to clear expectations. And this is where the question becomes, well, is this good news? Should the markets be happy about this? The response to the job openings number that we saw earlier in the week certainly seems to suggest it. As you can see here, the number came in at 8.8 million job openings. That's well below the 9.5 million expected, which would have been a decline as well, but a much narrower one. As it stands, we still have job openings well above their pre-pandemic average, which was about 7 million. You can see that in the data that you have marked here from 2018 and 2019. But nevertheless, it's been a steady decline. Now, what you'll notice, and this is a critical part of this story, is that the reason why the markets cheered this JOLTS data is ostensibly because it means that a Fed rate hike before the end of the year, another one, is less likely. And the response was textbook. Yields fell. Expectations for a rate hike before year end weakened. The dollar weakened. This was about as textbook of a good, the Fed will not be too hawkish kind of a response as you can get. So ostensibly, if this means that we are going to have a weaker NFP number, markets should cheer it also. But it may not be that simple. And here, unpicking this puzzle seems to be critical. So again, consider, we have a decline in hiring, but the jobless rate isn't going up. Tellingly, you can see the peak in hiring there, that 904 is about February. The peak in job openings at 12 million is March. So what you are looking at here, when you see hiring slow, when you're seeing this right here, and you see the green line trending cautiously lower, it appears that what you are seeing there is this: fewer job openings. Now, that feels obvious, but what it portends is that you don't have layoffs. You have less appetite for more labor, and so hiring is slowing, just as job openings slow. That speaks to cooling appetite to add more. What it doesn't speak to is firing, an actual reduction in the ranks of workers. And that might be the critical bit here for the Fed. Looking at the latest ISM numbers here, what we see is that employment in the service sector has been steadily growing. PMIs obviously work, as we often say here on macro money, on a logic centered around the 50 line. 50 is neutral, above 50 is expansion, below 50 is contraction. The further you go above 50, the more pace, the more momentum there is in the expansion. The more you go below 50, the more momentum there is in the contraction. Just like a PMI survey would be. So looking at these ISM numbers, what you see is service sector employment has steadily grown at a measured pace basically through the entire pandemic. We've not really seen dramatic declines. Manufacturing employment is certainly in contraction mode, but manufacturing is a relatively small part of the economy. The service sector accounts for close to 80% of all employment. So that we haven't had actual contraction of any consequence in employment really speaks to what you're seeing here, which is hiring is slowing, firing has not commenced. Now, this is a key consideration for the Fed because for them, the inflation that there is to fight is in the service sector. And we hear this from the Fed endlessly. We see this in the CPI numbers. And of course, we just got an updated set of the Fed's favored inflation gauge, the PCE index. And we see that in spades on that index just as well. At this point, the good side of the equation is actually a disinflationary force. You can see those little yellow bits on the bottom there for the latest two bars. That tells you that the good side of the ledger is actually taking away from inflation here. And if you look at the analog in the CPI report, you can see goods excluding food and energy, that inflation has basically been squeezed to nothing. And energy is actually pulling inflation lower. So the big issue here, services, as it is here. Now, the largest contributor to services inflation is actually housing services. And in particular, an estimate of home upkeep and imputed rent cost. So the cost to maintain a property as though it were being rented when in fact it is occupied by the homeowner. It's a kind of complicated measure with quite a lot of interesting statistical assumptions that are made, which start to question somewhat what it's actually trying to show you. But suffice it to say that anything related to the housing market is not anything the Fed can have immediate agency over in the near term, because the housing market can take years to clear. It can take years for supply and demand to adjust. So if the Fed is hoping to impact near-term inflation outcomes, the housing market isn't the place to go and try to move the needle. That leaves the labor market, the other big part of what is keeping inflation underpinned on the services side. And here, the difference between a slowdown in hiring and actual layoffs is actually quite important. What we see here really represents this dynamic, I think, in a very straightforward way. Let's break this down because there's a lot that's going on here. The blue bars here are labor supply versus demand, the balance. You can see there during the pandemic, there is an absolute surge. The blue bars shoot higher. And what that means is that there's much more supply than there is demand. Makes sense, of course. Everybody has gone home. Everybody is on some sort of lockdown. So there's all kinds of available labor. And no demand because businesses are closed. Economic activity has been basically mandated shut. As you start to get the reopening going into 2021, you start to see that come closer into balance. So you start to see labor supply, again, this is relative to demand, come down as that demand starts to suck up more of the supply. As you get into 2022, what you get is increasingly a disparity in the opposite direction and a deepening deficit. That deficit now at about 3 million workers. And what you see here is it has been somewhat inching in a positive direction. So it was as high as about 6 million around the second quarter into the middle of last year. And it has worked down quite a bit, but not nearly so much as to mirror where it was before the pandemic, where the averages were sort of 1 million, 1.5 million, and really no higher. Now, of course, this is a problem for inflation because if there is a deficit in the labor market, that bids up wages. Wages then make labor more expensive. More expensive labor makes doing things with that labor more expensive, so it makes the price of the things that are being done more expensive, and this feeds into broader inflation. The service sector, of course, as we just said, the largest employer, also the largest sector of the overall economy, so you feed that, and you feed inflation writ large. What we've seen from the peaks in inflation last year, that 7% peak on PCE, the 9.1% peak on CPI, is slowing of global trade, fixing of supply chains. All of these things have done wonders to bring inflation down. But where it is sticky, the move has been far less pronounced. And there, I point to this yellow line. That's the ECI, the Employment Cost Index. And what you see in that employment cost index is that it still runs well hotter than CPI or PCE, and it has been far more resistant to going lower. And this, of course, is precisely what the Fed is aiming at improving. Now, if the Fed is able to slow hiring, so we can see that's worked some way into this equation. The supply-demand imbalance has been improved because, at least on the demand side, job openings plus the people that are already employed make up the demand side. And if you reduce job openings, well, then things improve. But what you can't do by slowing hiring is do anything to undo the wage gains that have already been priced into everything because of the hiring surge going out of COVID, where that surge in inflation numbers you see here as the deficit takes shape has locked in wages at higher levels and therefore has locked in sticky inflation at higher levels. It has not really given way. You see that in spades when you look at how the Fed policy outlook has evolved over the sort of latter half of the second quarter and into now, as compared to inflation expectation, which is, of course, precisely what the problem for the Fed looks to be. Here you have not necessarily the outlook for any given meeting, but just the 12-month forward outlook on Fed funds rates as it is implied in Fed funds futures, so interest rate futures 12-month forward. So this is, again, the actual market view. This is what is priced in. This isn't anybody's opinion or forecast or the output of some model. This is the price action in the market. What you are seeing here is that from about May, worries about the banking crisis and the U.S. debt ceiling fiasco start to recede. The rate cuts that were baked in from March onward, you can see that aggressive decline there in the orange line in March with the banking crisis, and then a failure to rebound once it ended because all through April and into May, you're still worried about this U.S. debt ceiling nonsense. And so right around May is when both those things seem to kind of go into remission as far as markets are concerned, and Fed policy expectations start to shed the cuts that were assigned to be the response to either one of those event risks going sideways or going left, having some kind of adverse outcome. Once that fear went away, Fed rate hike expectations started to build. But what they didn't do is bring inflation expectations any lower, even though the outlook became much more hawkish. So as of May, what we were looking at was Fed rates at about 3.5, 3.25 1 year forward. At this point, we're looking at 5. That's a change of over 1%. And of course, some months have passed in between that time, but clearly a difference of 1.5% is almost a year's worth of rate cuts, typically. Rarely does the Fed feel the urgency to cut faster than about a percentage point a year, unless there is some kind of a crisis. And so what we're looking at here is the stickiness of wages that have already been baked in. So unless you get a rise in the unemployment rate and you get actual firing, ostensibly the Fed does not see any reason to back down, even if hiring at the headline non-farm payrolls number cools as job openings have. So this raises an important question. If you get an NFP report tomorrow where the headline payrolls number is in fact softer, but the unemployment rate still holds near historic lows, as we see in the expectations, are the markets likely to cheer that? Well, let's look at Fed policy expectations and see. We already are looking at basically a 50-50 shot for a rate hike before year end, and only very narrowly so. You can see the probability for a hike before year end peaks out in November at about 50%. So at this point, the markets can go either way, but they seem to be in remission. They were looking at the possibility as closer to 65-ish% as recently as at the start of this week. So here, it's basically a coin toss, but it's not really priced in that there is going to be a hike at this point. So there may be some reactivity there if the soft number brings that a little bit further below 50, but it doesn't seem like there's a whole lot more to go. Rather, the meat of the conversation probably has to do with when the rate cuts start. And you can see here we expect the first cut, it's almost fully priced in at about 80% in May. From there, you have fully 2 cuts baked in by July, fully 3 and a 70% chance for a 4th by November, and the 4th with a 30% chance for a 5th by December. So the markets are envisioning at least 100 basis points or 1% in rate cuts next year. If the unemployment rate does not go up, that narrative might well be challenged. And it may well be that the headline, the decline in non-farm payrolls, really fades from focus, because the real question is, when will the Fed start to give some relief? And of course, that's important because we've just seen economic data over the past week or two all but confirm that the Eurozone is in recession, that stagflation in the Eurozone is all but certain at this point. That, of course, makes things tremendously challenging because, on the one hand, the central bank needs to raise rates to cool inflation. On the other hand, it needs to cut them to boost growth. And the pain typically falls on the currency, which has, at that point, no good outcomes. You hike rates, that's bad for growth. You cut rates, or at least you let the current rate hold and let inflation burn through, and that destroys the currency's purchasing power to a significant extent and drives it lower. But what this means for global growth is that about 15% of global GDP is now basically misfiring. Add into that 18 to 19% that is made up by China, which still can't get off the mat after attempting a post-COVID reopening in December. That economy seems to be coming apart at the seams. That leaves just the U.S. as the major catalyst for global growth and as the kind of last line of defense, keeping the globe from a coordinated, broad-based recession that is global in nature. If the Fed is going to keep rates higher for a more extended period, that, of course, kicks out that very last line of defense. And then a global recession is precisely where we're at. So if the unemployment number does not go down here, but it doesn't go up, if the Fed doesn't see evidence that would suggest it needs to really start to think about this easing cycle, and that's what we walk away with from tomorrow's numbers, even though the headline NFP number might tick lower, the upshot might well be negative for markets, because they might look at this and say, well, a global recession isn't good for earnings. That's not good for growth. I guess it's good that the Fed won't hike rates again, but we weren't really convinced of that in any case. There's not a whole lot to price out there. What there is a need to price in a greater global recession risk, because if the Fed wants to see a rise in the jobless rate and doesn't see it, it's going to keep choking the U.S. economy with restrictive monetary policy at a time when that U.S. economy is the only game in town as far as global growth is concerned. And of course, the more you choke it, the less potent of a counterweight it is to weakness elsewhere. So what you may well end up with is a lower NFP number that the markets say is bad news. Not because it is necessarily bad, but because it doesn't solve the underlying issue of higher borrowing costs that the markets so desperately want some relief from. Because the business cycle appears to be turning. And so the NFP number, where the jobless rate isn't rising, might well end up with lower stocks, higher bonds, a stronger dollar, a stronger yen, which tends to benefit in risk-off markets, and weakness in cyclical and growth-sensitive commodities and currencies, so the likes of crude oil, copper, Australian dollar, Canadian dollar. And that would be a very telltale sign for how the markets intend to treat economic data and the things that they will be caring about in future economic data as we go forward. And that is Macro Money for today. It's also the last episode for this week. We are here Monday through Thursday every week, right after overtime, with that very music kicking off when we begin our show. If you weren't there for the start, that's the music you'll hear as we transition from Overtime to Macro Money. Overtime, a show I do with Chris Vecchio, head of futures and Forex here at Tasty Live, where we try to make sense of what happened on Wall Street that day and what it might mean going forward. I'll be on with Chris tomorrow for Futures Power Hour, where we meet every Friday, and of course tomorrow will be special because we'll discuss the aftermath of this jobs report. I'm typically on with Tom and Tony Sundays for First Call, but we have the Labor Day holiday here, so that will be pushed to Monday next week. I hope to see you there. I'm also opining on the news and insights section of tastylive.com, where in fact there's a write-up of this very video at the moment, if you wanted a written summary, and also issuing sporadic commentary on Twitter. Yes, Twitter, at Ilya Spivak. Thanks very much for joining. Macro Money will be back next week. Take care.